Straight to the point. If your trading right now is based around some kind of hunch or gut feeling or some kind of emotion, then you already know that there's no way for you to be profitable with that being the case, right? So right now, if you don't have some type of systematic strategy that you follow and that's proven to be profitable for you, then this video is just for you. In this video, I'm going to teach you a very simple strategy that only uses 5 different steps, only price action, and 1 indicator to help us place our stop loss. Other than that 1 indicator, we're just looking at price and making very logical decisions based on this 5-step trading strategy. So with that being the case, let's go ahead and dive right in. I'm gonna let the intro and disclaimer roll. While I do, click that like button, go ahead and subscribe if you are new, and click the notification bell, and I'll see you directly after. Let's not waste any time and dive right into this 5-step trading process. First off, the trade you see running on the screen at the moment is a trade that I used this 5-step process in order to get involved in. And because of that, I will be using this trade as an example as you learn about it. Our first step in the 5-step process is to go to the daily chart. I always start here because I want to know what is the underlying trend of the overall market, along with where are my areas of value. So with that being the case, the very first thing I do is go out to the daily chart. Let me actually take you back in time a bit with the market replay tool and put the market where it was when I started looking for this trade. And this is about where the market was. At this point, what was our very first step? What is the underlying trend of the market? That's step number 1 in this process. So the underlying trend of a market is determined by exactly that, the trend. And the trend is determined by, is the market making higher highs and higher lows? If the answer to that question is yes, if the most recent thing that price did was make a higher high compared to its previous high, then we do have an uptrend. As long as the previous low has not been broken, then that continues to be the case. So in this case, do we have an uptrend? Yes, we do. So we have our criteria met for an uptrend. That means I'm looking for buy trades with the ugliest B I've ever written. That means that I'm going to be looking for buy trades. So step number 1 is determine if you're going to be looking for buy trades, another ugly B. Man, I just can't get the B's down today, can I? Or sell trades, right? That's going to be the very first step. Considering we're in an uptrend, we're going buy trades for this scenario. Now, my second step in this process is to find an area of value that's likely to cause price to continue. In an uptrend, for me and what has happened throughout my experience is the latest level of structure resistance that was broken very often becomes support in that market to either push it into new highs or at least come up back to the previous highs before a reversal. So with that being the case, looking at the market down here, where is that area? Should be pretty easy considering that I already have it pointed out for you. This was the latest level of resistance that was broken in this uptrend. And because of that, it is the most likely area that price will find support if it gets to, and that support should at least be enough to hopefully, and this doesn't always happen, nothing always wins in Forex, we'll talk a little bit more about that later, but we give ourselves a really high likelihood chance of price continuing up when we point out the trend of a market, decide we're in a buying mode, and also we look back at the previous level of resistance that was broken in an uptrend. So what's the next step in this process? Well, the next step would be to go down to a smaller time frame. For me, that is going to be the 4-hour or the 1-hour chart. On this specific trade, I went down to the 1 hour. Those are the time frames I use. You can adjust those time frames if you would like. But for me, the lowest I go is the 1-hour chart. I'm more of a swing trader anyway, so day trading doesn't really appeal to me like it used to. Anyway, here on the 1-hour chart, once you've went down to your smaller time frames, the only thing left to do is find a reason for entry. And to make this extremely simple, here's what I would love for you to do. Demo trade this exact 5-step process for the next 3 months. And just take time off from live trading, especially if right now you're in a position of just struggling or you're in a position where you're losing money. Take 3 months, demo trade this, and only trade when you see double bottoms in these areas. That's it. Keep it as simple as possible until you find a system that wins for you over a large sample size, over a long period of time. But for this example, this is exactly what I used. Was a very simple chart pattern. Now, of course, I do have a few other entry reasons, but again, to keep things as simple as possible for this video, only look for double bottoms for buy trades, and it would be the opposite for sell trades. We'll look at those later in the video. Double tops only. That's it. That's all that I want you to look for over the next 3 months. Try it on a demo account, leave comments below, and let everyone know how it worked out for you. But anyway, keep that in mind. I'm looking for a double bottom in this area. What does that look like to you? If I scroll up here, and I actually have a full video on double bottoms, I'm not going to go through it here. I'll put a little card up here in the top right corner though. And if you want to see that full video, you can just go to it and it'll show you my exact rules for a double bottom. But here, those rules are met. We have our first bottom. We then have the neckline of a double bottom. We have that second bottom and a nice hammer candle. I got involved a couple of candles later after a little bit more buying pressure just to give myself some confirmation. And that is step number 3 in this 5-step trading process. So step number 1, find the trend of the market on what time frame? Out here on the daily chart. Step number 2, find the area of value that's most likely to continue that trend. It is always, for me, going to be the previous level of resistance that was broken in an uptrend. We're going over the bearish example later, but it would be the previous level of support broken in a bearish trend. That's always going to be the greatest area of value for me in my own personal trading. Choose to use it, choose not to use it. That's what we're using for this example today. The next step after you have your trend and your area of value is to go to lower time frames like the 4-hour or 1-hour charts. And what are you looking for? In the most simplistic version, just looking for double bottoms. Now, step number 4, this one's going to be complicated, completely joking. Step number 4 is just to put a stop loss in an area that makes sense. And I'll give you a really easy way to do that. It's called the ATR indicator, or average true range. It gives you the average of the last 14 candles that were printed. This way you stay in line with the volatility of the market and the pair that you're trading. The reason we do this is because pairs like the Aussie dollar or the dollar Swiss may have a really low ATR, like 20 pips. On the 1-hour chart, it might even be lower than that, it might be 10 pips. Whereas pairs like the pound Aussie or the pound New Zealand's a great example of this. The pound yen are going to have more like 25, 35 pip ATRs on the lower time frames, even like the 1-hour chart. And all that means is that the candles are moving a lot more. So you want to stay in line with that volatility. The way I do that is the ATR indicator. Super simple to find. Go to indicators, should be on any platform. Type in ATR or average true range, and it should be one of the first ones right here. It's under technicals, average true range. Click it, it'll be plotted on your chart. So upon the candle that I enter into the market, I look up to the top left, you'll see 0.260. We don't count that last little tick in the Forex market, so that's really just 26 pips. So what I did was 1 ATR or 26 pips below the lowest low of my double bottom, because that's a spot that makes sense. The reason that makes sense is because if this double bottom pushes up and then pushes down and starts making new lower lows, then the likely scenario is that I'm wrong, and I want to get out as fast as I can when I'm wrong for minimal stop losses, for minimal losses in my overall account in terms of the money that I lose. I don't want to lose much. And so the moment that I know I'm wrong, if we start making new lows, I want to get out. I want to be stopped out and cut my losses there. So step number 4, put your stop loss somewhere that makes sense for me in my own personal trading. This is kind of a risk management thing, so I'm not telling you what to do whatsoever. But for me, that is below the lowest low of the double bottom. And I usually use the ATR indicator. If you want to use a set stop loss, that's completely fine too. You could just go 10 or 20 pips every time, whatever's easier for you. Step number 5 in this process, after we have the trend, we have the area of value, we've had our double bottom, we've placed our entry and our stop, the next thing you're going to do is place a target. You're going to have an area that you're going to get out of the market. For beginners or people who are struggling right now in their trading, you don't want to try to use multiple targets. You don't want to try to use what I call dynamic targets, meaning that you don't have a set target anywhere. You want to actually set an actual order to get out of the market when you're right. Here's how I like to do that. The candle that is the swing high before the pullback, I want to go on the lowest part of the body of that candle. The reason is I would absolutely hate to have my target up here at these actual highs, and then I would I cannot stand when this happens. I'm actually getting frustrated just thinking about it. I can't stand when price does this and then drops and it gets this close to my target. That drives me crazy. So what I found is best is to just go with the lowest part of the body of that swing high before the pullback that got into our zone, okay? And that's how I like to take targets if I'm gonna use a fixed target that's above a 1-to-1. I very often get between a 3 or a 4-to-1 with this kind of scenario. And the reason for that is you're basing your stop loss off of the 1-hour chart and you're basing your targets off the daily, which gives you a really good reward to risk ratio a lot of the time. So step number 5, place your targets near the swing highs out on the daily chart. And that's it, guys. It's that simple. 5 very simple steps. And this is how I've created some of the most profitable trading opportunities I've ever had, is just with these 5 extremely simple steps. Let's go through a bearish version of this as well to make sure you have a good handle on this 5-step price action trading process. Before we continue the video, if you are tired of the YouTube black hole that is trying to figure out how to trade on your own and you want a more organized approach to understanding the Forex market and becoming profitable, then we do have some space available in the TTC Forex University. Just wanted to make you aware of that. Go to www.ttcfxuniversity.com. That link's on the screen as well if you'd like to learn more. So let's go over to the Euro Canada for a bearish example of this. Let's go out to the daily chart. We're going to start our analysis here. What are we looking at? We're trying to determine the trend of this market so we can see if we need to be buying or selling. Which direction do we want to go in this case? Well, considering that price is making lower lows and lower highs, just like this, we are in a selling mindset. We want to look for areas to go short in. So our step number 1, find the trend. That is complete. The trend is down. What's the next step? We want to find the area that price is most likely to hit and continue trend from. And that normally is going to be, and for this 5-step process, is the previous level of support. So in the case, if we draw out the Euro Canada trend, in this case, we have a swing low to a swing high to a swing low to a swing high, swing low, back to swing high, down to new swing low. This area right here that I've drawn out, and I'll actually use my horizontal line tools to do this for you. This area right here is in fact going to be our area of resistance, the likely area where price is to come to and then push down from is the previous level of support that was broken like this. Now what's our next step? Our next step would be to go down to our smaller time frames, like the 4-hour or the 1-hour charts. That would not classify as a double top for me right there. And there's reasons why. Again, if you want to look at that video that goes over my double bottoms and double top rules, it'll be up here in the cards, but I just wouldn't classify that as one. And you can go to that video to see why. Now this, on the 1-hour chart, is in fact a double top for me. So this double top, my entry would probably be around here after seeing some selling pressure and after we found our double top. What's our next step? That was step number 3. Step number 4, find our stop loss. How are we going to do that? Hover over the entry candle. You can see that 24 pips is the ATR of that entry candle. So I'm going to go above my highest point of the double top by that number, by 24 pips. So we have 40 up to that. 40 plus 24 is going to be 64 pips on our stop loss. Now, in some cases, like we have here, I'll go out to the daily chart and explain this. What you're going to see is that the only area you have that you could possibly take targets is the bottom of the body. So if that's the case, that is completely fine. So that's where I'm going to be placing my target. Now, in this case, you can say that you only allow yourself to trade if you have larger than, let's say, a 2-to-1 reward to risk ratio. And that's completely fine. You just would skip this trade. For me, I'm okay with anything above a 1-to-1. That's totally fine with me because normally I win between 50 and 60% of these trades. So even if it's only a 1-to-1, I still have an advantage in terms of placing the trade itself. So in this case, this is actually a trade that's still running. It's not one that I got into personally, but it is still running at the moment. It has done a lot of consolidating, a lot of playing around with emotions if you had been involved in this trade. But currently we're sitting at about a quarter of the way to the targets at this point right now. So going over the 5 steps one more time. Number 1, we're looking for the trend of the market. Number 2, we're looking for the area of value. Number 3, we're looking for double tops or double bottoms, like our first example. Number 4, we're looking for our stop loss with the ATR indicator right up here, and the top of the double top, the highest high, or the bottom, lowest low of a double bottom. That's how we're gauging our stop loss. Number 5, we're looking for our targets. And we're doing that based on the daily chart somewhere around the swing high or low that was just created. Now, obviously there's a lot more that goes into successful trading than just having a strategy, but having a rules-based strategy you can stay consistent to and that makes you profits over time is absolutely one of the biggest steps that you need to take in order to get to the end goal of being a profitable trader. And I don't have time to go over the other steps, which include trading psychology and risk management. I'll draw out a little graph for you guys that I like to use called the triangle of trading success. And if you want to learn more about risk management or trading psychology, feel free to go just type it in on YouTube. You'll probably find some of my videos on those topics if you just type it into the YouTube search bar, or if you want a completely organized way of doing that, you can go to www.ttcfxuniversity.com and join us over in the university. But the triangle of trading success looks a bit like this. And you guessed it, it's a triangle. Inside of this triangle, it's essentially the ingredients that make up a successful trader. These are all the traders that make money from trading, the 5%, if you will. They all have a strategy that is rules-based enough for them to stay consistent to. They all have a good handle on risk management. Now, why do you need this? Well, initially it's so you don't blow your account. And it's also so you don't lose too much on one specific trade. Another reason that we need a risk management plan is to help us kind of control our emotions, because the more of our hard-earned money we have at stake in a trade, the more emotional we're going to be during that trade. So the more we can minimize that hard-earned money that we're going to lose, minimizing that is using risk management, then the more emotionless we'll be while we're trading. The next step is trading psychology. And this just comes down to understanding that wins and losses are a major part of trading. You're going to have losing streaks, drawdowns, but you're going to have to be okay with it. And one of the best ways to help yourself with trading psychology is going to be back testing and also forward testing on a demo account, so that you can actually watch an account go up and down through drawdown and come out of it with a specific strategy that you're using. This is one of the biggest reasons I said earlier that I want your next steps to be spend the next 3 months just demo trading exactly what I showed you. And if you're someone that's losing trades right now and you're kind of consistently seeing your trading account, it looks like a downtrend, it's just consistently dropping, stopping trading for 6 months or 3 to 6 months is going to be a good thing, because at least then you won't be losing real money. So instead of trying to continue trading and just bleeding that account all the way dry, stop and try to demo trade exactly what I showed you. If you come up profitable within the next 3 months, not only is that going to help you with your trading psychology, but it also means you've now found a strategy that you can stay consistent to, or a 5-step process at least that you can stay consistent to. That's going to do it for this video, though. I hope you guys enjoyed it. Remember, there is space available in the university if you want to join us. It's www.ttcfxuniversity.com. Make sure you're subscribed. Make sure to leave me a comment if you made it to the end. I always appreciate that. And also comment below with any other topic that you guys would like me to discuss or that you are struggling with. With that said, I'm going to let you go, and I'll talk to you in the next video. See you soon.